So Tesla is dead money. At least that's what mainstream media wants you to think. Now also we have Cramer saying it's no longer part of the Magnificent Seven. I didn't know Cramer had the authority to add or remove companies from the Magnificent Seven, whatever that means. We have Intel diving into the dumpster. We also have Microsoft laying off 2,000 employees. And we have Alibaba basically coming back from the rubble like a phoenix from the ashes. And the US economy is actually doing way, way better than anybody has anticipated. All while China and the rest of that part of the world is basically going into the toilet. Now let's start with Tesla first because as I mentioned, I start my days thinking about Tesla and Palantir, and I'm sure that if you're here on the channel, you're pretty much the same. Now look, I want to keep these videos brief and short, so let's cut to the chase. So we have this clip from CNBC in which some very smart lady talks about how Tesla is dead money. Let me play the clip.
I think it will be dead money over the next couple months. Once things settle, I'm long-term bullish on the name. I think the manufacturing prowess is incredible. But right now, you really just can't touch this name because I think the sellers will continue.
Now, I have one rule, which is do not try to time the freaking market. It's as simple as that. It's not complicated, and it's quite straightforward. There's no point in trading this stock. It's crazy. It's going to punish you like an ex-girlfriend out of hell. Buy and hold long term. Don't like the company anymore? Sell it. Buy a different company you like better. Simple as that. When you try and actually pick up pennies from the train tracks, eventually the train is going to hit you. And Tesla is one hell of a train you don't want to be hit by. Tesla is currently in the middle of a very, very shameless campaign to smear all over Tesla and Elon Musk, and you can see it in mainstream media every single day. And just to show you what it looks like, you have Cramer today saying that Tesla is no longer part of the Magnificent Seven. The great Cramer, who told you to buy Bear Stearns and told you to actually invest in Bear Stearns and told you to buy DD Global, the great Cramer is now saying that Tesla is a bad idea. You can see it on CNBC, and again, I don't know if this is intentional or just like Pavlovian reaction to bad earnings. I don't know, I couldn't care less. When I see Cramer talking bad about Tesla, I get excited, honestly. But it also tells me there's something going on here on the street. I was looking at CNBC yesterday, and they had a slide up talking about the results of the earnings call, and they literally had misinformation there. For example, that slide shows that Tesla said the delivery numbers for 2024 will be lower, when in fact, in the call, they said the growth will be slower. Again, semantics, and it really, really is a tiny change, but it makes a huge difference. Another thing we saw that slide was that the Chinese are coming for Tesla. That's what Tesla said. No, Tesla said that the Chinese are coming from the big three, for the GMs and the Fords of the world. They're not ready. Again, little semantic changes that causes fear. When do you think institutional investors are buying Tesla stock? You think they're buying it at 300? No, they're buying it when there's plenty of blood and fear in the water. They don't buy at the peak. They buy now when everybody's scared and running for the hills. I'm not telling you to buy Tesla, by no means. I'm just saying that the time to buy is where there's blood on the streets, especially if that blood is yours. Think about what happens to Tesla when they actually sell that $25,000 car. Think about the ramp of the Cybertruck. Think about the FSD in which they got monopoly. Think about the robotics, the engineering, the energy, the endless amounts of S-curves they have lying around on the floor like a piece of duct tape. You really believe this company is going to stagnate itself into a slow, painful death? I don't think so. But again, to each their own, my own opinion, doing research, this ain't financial advice. Now let's move on to Microsoft. So Microsoft just laid off 1,900 employees in its gaming unit. And everybody's talking about the fear factor. Everybody's scared. The gaming industry is in trouble. The interest rates are killing startups. Tech is in jeopardy, etc., etc. All this massive fear campaign going on, when in fact, it's nothing of sorts. Now, obviously, there's problems, especially in the tech industry, especially in startups, when interests are high. However, it's not as bad as it seems. The simple truth of what's going on with Microsoft is this was well expected. When Microsoft decided to buy Activision, that merger was done to create synergies, among other things. Obviously, they had other agendas, but the idea was, let's combine and merge so we can get rid of these 2,000 employees we don't no longer need. Think about it this way. When Microsoft and Activision decided to merge, by definition, a number of jobs will be eliminated because they exist in both companies. That's exactly what happens. That's the idea of synergy. Unfortunately, synergy means getting laid off for some people. But again, we're talking about a company that knows what they're doing. Microsoft is up 63% on the year. They're up 300% on the 5-year. They know what the hell they're doing. I wouldn't be criticizing them so lightly. Now, is there reason to panic in the gaming industry, in the tech industry, in the startups? Not really, since we seem to be at the tail end of this restrictive monetary policy. However, Microsoft cutting some jobs, and other companies are laying off as well, it's a sign that it's about time for the Fed to start pivoting back into a little bit more reasonable interest rate, which they seem to have decided to do later in 2024, according to all predictions, but we'll see how this plays out. Now, let's talk about Alibaba. This is a fascinating story. So Alibaba is on the rise after a very, very long winter, up 10%. Because Jack Ma bought $50 million worth of shares. Now, whenever a founder or a CEO or both, by the way, he's no longer the CEO, but he's still a huge shareholder of the company. He got kicked out by the Chinese government. So whenever a significant person in the company buys a huge chunk of shares like that, it's a huge vote of confidence. For the retail investors, it's a sign that they believe in the company. We had Anthony Noto from SoFi do the same thing, and it proved itself, obviously, right? So you have a lot of euphoria. A lot of people follow Jack Ma into the stock because he actually put his own money on the line. However, I have to cool the jets here a little bit because it's a very unique situation. This ain't SoFi. Number one, I'm not even sure that Jack Ma was actually the guy who bought this. I know I have my theories about the Chinese having his, fingerprint or something. I don't know. I'm just kidding. I'm kidding. Let's assume he bought it. So assuming he bought it, it shows that he has a lot of confidence in the company. But the problem with Alibaba never was the quality of the company. The quality of the company is great. The Alibabas of the world are not plentiful. There's not a lot of companies like that. Alibaba is great. No issues with the company itself. However, the problem is that Alibaba is located in a geography where the government really will do anything to destroy you just because they feel like it. That's why the stock dropped from $300 to $75. Not because it's a bad company, not because it's unprofitable, because the Chinese government is arbitrary, unexpected, and absolutely maniacally crazy. You never know what they're going to do. They imploded DD Global, they imploded Ant, they've stopped the IPOs. All this heck that's going on in China is basically a risk nobody can quantify. Nobody wants anywhere near this, and that's why the stock is down from $300 to $75. Ask yourself this question. Will Jack Ma buying $50 million solve the problem? Would Jack Ma buying $150 million worth of stock solve this problem? No. You can't solve the Alibaba problem without taking Alibaba out of China, which at this point seems a little bit unfeasible, but we'll talk about it in another day. Now, the US economy keeps growing at rates that are quite surprising. This time we have a 3.3% pace for the fourth quarter, which is absolutely terrific. And there's a reason why the United States is the most resilient, the strongest, and the best economy in the world, and why it will remain so in the foreseeable future, at least in our lifetime. You see, as long as the United States holds the reserve currency status for the dollar, they get away with a lot of crap other countries can't. Turkey is one example. Turkey is now at 70% inflation and 45% interest rates because they don't get to print the world's money. Now, obviously, you don't want to bet against this economy, but how can you benefit from it? Well, look, the strength of the US economy, the strength of the US dollar is very, very simple to utilize. And in fact, it requires zero effort. Just buy the S&P 500, buy the US economy and hold it for decades, make money, go home, and don't ever think about it. Quite simple. Now, let's talk about Intel. So what happened with Intel is actually very interesting. So Intel went through this metamorphosis. They brought back Pat Gelsinger, who came in and basically decided to change the entire business model. So Intel was losing to AMD, to NVIDIA, to a bunch of other companies, and they've decided to pivot away from the previous visions of world dominance into competition with TSMC. Intel said to themselves, look, we still have factories. We're not fabless, so let's utilize that. Let's make good of it, which isn't a bad plan when you think about it. The problem is it takes years and years and years to get done. And right now, we just saw this in the earnings. The earnings came out. They were abysmal. The stock dropped 10%. So what's going on here? So obviously, the PC market, where Intel makes a lot of its bread, still haven't fully recovered. On top of it, the whole core server business that they have is basically gone because NVIDIA took it all. NVIDIA is now in the process of basically selling to everybody. The Intel server business is pretty much dead in the water. And they're going to be dead in the water for a while because spending on NVIDIA stuff are going to continue for years. So the only way out for this for Intel is actually to promote the founder business and start making money there. The problem is that while this is going to take years and years and years, better companies like AMD and NVIDIA are going to make a whole lot of money while Intel goes for this Hail Mary to compete with TSMC, which in itself, again, as I mentioned, is not a very rewarding exercise. I mean, TSMC are quite good at what they do. Now, look, you don't need to be a rocket scientist or a neurobrain surgeon or whatever it is, right, to understand that AMD and NVIDIA are better stocks than Intel. I mean, that's quite evident. And that's why they're priced accordingly. So there's not a lot of leeway there to make money. That's why 5 months ago, I made a video telling you, look, I found a stock that's going to be completely correlated with NVIDIA in that server business, and it's going to make a lot of money, but it's not yet priced in like NVIDIA. And this is a stock we've been talking about on our Patreon group, patreon.com/Tom Nash, and on our Discord. And we've been saying how this stock is going to balloon because of its correlation with NVIDIA. So 5 months ago, I posted that video. Right now, this stock is up 50% after 5 months. It made a lot of people a lot of money in our group. Go check it out. The video is going to be linked below if you want to watch it. But the real question is, how can you find stocks like that? And the answer is quite simple. Number one, find somewhere to educate yourself on how to become a better investor. One way is to join our academy on our Patreon. For example, yesterday we had a great lecture about how to analyze financial statements. It was lesson 4, and we were talking about quality of earnings. How to actually find red flags in earnings and avoid BS. Once you have the knowledge, you have the skill set, you also need the right tools. That's why me and my partner Pete have developed Stock MVP. Stock MVP is a tool developed by retail investors like us for retail investors like you that give you all the information, all the access, none of the paywalls you have in the other software that cost hundreds of dollars per month. It's cheap, it's accessible, and it's easy to use, and anybody can use it within 5 minutes. You can try it out for a week for free, and we have a coupon code for 40% that's actually expiring within 24 hours. Everything is in the description below, stock-mvp.com. Go check it out. See you in the next video.